Hi, welcome to Archiversity online classes. By this time, you may have some understanding on stock return pattern. And you observe that the return patterns are random or volatile. Sometimes it is high, sometimes it is a low. Now the question comes into our mind is there any way to find out whether the return series of a particular month is uniform with the return series of a second month? Using a Microsoft Excel data analysis tool pack, you can perform a paid sample t-test. By using paid sample t-test, you can measure the performance persistence of a stock for two time periods. The two time periods may be a previous month and this month, or a previous quarter, this quarter, or a previous year and this year. Now I'll show you how to calculate paid sample t-test using a Microsoft Excel data analysis tool pack and interpret the result. I'm not going to teach you the formula of calculating the t-test or how is it you are going to test the hypothesis. Simply, we use the analysis tool pack, then try to interpret the result. Here, I have a daily return series of a particular stock for 2 months. One is June month and the other is a July month. Now I'm curious to know whether the return series or the mean return of a June month is similar with mean return of a July month, as I am making a comparison or a performance persistence between 2 months, that is June and July, of a particular stock. To measure the performance persistence, you need to use a paid sample t-test. Why is that we are using a paid sample t-test? Is the samples are drawn for the same stock, that is a Hindustan Petroleum Corporation stock. For the same stock, I am taking 2 different time periods. To measure the performance persistence, we use the paid sample t-test using a data analysis tool pack. For that, click on data, then click on data analysis. Now from data analysis tool pack, choose t-test paid to sample for means. So select this one, then click OK. Now first is variable 1 range. Click on the arrow, then select the data for variable 1, that is for the June month. Then click the down arrow here. Next, variable 2 range, click on up arrow. Then select the data from beginning to end. Then click on the down arrow. Now click on the labels, because we have a labels, that is in our row 1. We have a June month and July month. Click on labels. Alpha is the significance level. That is, I am putting a significance level as a 5%. That means I am testing my hypothesis at a 5%. And the hypothesis that we frame here is there is no difference between the mean return of June and July. That means they are same. Mean return is the same for both June month and July month. Now click on output range. Then click the up arrow, select the cell, then click a down arrow. Now click OK. So here is the result of a paid sample t-test. We just format this one. Then now observe that the mean return for the June month is 0.005, whereas for the July month it is a 0.00. There is no positive or negative return for the month of July, whereas in a June month you have a positive return. And the variance 0.001 and 001 both have a same variance and both have a number of observations 21, and the correlation is 0.186. So here we look at the two-tailed test, because we are saying that the mean return of a June is equal to mean return of a July. So not equal to mean, it may be a high or it may be a low. So as you are looking at both the sides, on the high side as well as the low side, we look at the two-tailed test. And the critical value is 2.086 and the power value is 0.560. So as the power value is greater than 0.0 5, that is as it is a greater than 0.05, that is our significance level, we accept the null hypothesis. In the sense, there is no significant difference between the mean returns of June month and mean return of a July month. What this acceptance of null hypothesis indicate? It indicates that the mean return of a particular stock in the month of a June as well as in the month of a July are uniform. That means even though there are slight variations within the time period, but overall the means are same. That means the stock performed consistently during June month and July month. The assumption that we make here for a paid sample t-test is the return series should be of the same stock, that is one, and second is the number of observations should be uniform. If you look at here, the observations are 21 in the month of a June as well as 21 in the month of a July. But in practice, you may not have a similar kind of observations because some months will have a high trading days, maybe 23 or 22 trading days, and a few months will have a less trading days like 18 or 19. In such scenario, you can't apply t-test with a paid to sample for means. Then what is the alternative? So the alternative is you can go for an analysis of a variance. In my next lecture, I'll show you how to measure the performance persistence of a stock when observations are uneven. Thank you.